perspective. And Jayakumar is now joining us. He's Managing Director at Prime Securities. Jakes, great to have you with us here. Good afternoon, and thank you for your time. You know, you believe that what we're seeing with the IT services space today, even after the recovery, stocks are down quite a bit, this will funnel money into some of the under-owned parts of the market. Capital goods, engineering, manufacturing basically is a theme which should do well. It's a sector you've liked in the past as well. So I just want to start there. Your thoughts briefly on what's happening with IT and whether we'll see names like Infi, etc., being dead money for 6 to 12 months. And second, what does it mean for other under-owned sectors? Go on.
Well, thank you for having me over. And yes, that's a correct observation. My orientation has been towards manufacturing, especially over the last, I would say, a few quarters. The fact that IT is taking a backseat now, a lot of these companies had, as I said, an ongoing set of orders which kept the last 2-3 quarters, to my mind, optically higher than they should have been. To some extent, I think the slowdown is now really beginning to bite. And I think the next few quarters could actually see them having more headwinds than has even been seen as of now. The good news is that a lot of the cost arbitrage continues to happen out of India. So maybe they are protected a little more in the fall compared to a lot of the other IT players. And my own assessment is some of the mid-cap players could actually lose out a lot more. The mid-cap IT names were going at valuations that were significantly beyond beyond historical averages, etc. And they will correct, as indeed will the frontliners. The frontliners offer defense to the extent that there's lots of cash in their books. They've been doing buybacks, etc. But even more recently, buybacks done haven't helped the stock to be at those levels. In fact, they are significantly below buyback levels they've done even a year ago. So from that perspective, it's a sector that I will avoid. I think there's a lot more bad news in terms of either orders getting retracted, etc., coming through, and I would not want to be in that space. The money which is there currently could and will move, to my mind, to the manufacturing space, move especially to the capex space into the run-up for the elections. I see a lot of projects being announced. I see a lot of private sector capex being announced, and I see money being spent in that area. So clearly, one of the favored sectors will be the manufacturing and the capital goods. And from an export perspective, because a lot of people also had this dollar rupee weakness in mind, I think the pharma, which has been under-owned and unloved in a manner of speaking for the last now few years, I think pharma will begin selectively to see a lot more money flow come through. And even on a basket basis, money coming through to the pharma space is clearly on, and that could come out of IT. Both these spaces, manufacturing and pharma, could be benefited at the expense of IT.
All right. Hi, Jakes. Good afternoon. Unloved has been pharma, but I think what's been loved and what's been spoken about so much is ML and AI, artificial intelligence. And it seems that you're as well interested in that space because, Prime Securities, just looking at the BSC disclosure out there, you've gone ahead and bought a UK-based company. In a minute or so, if you could just explain this to us. It appears it's a fairly large dilution, but what is the potential from here?
So I think one thing is very clear, that in the services space, and I think we need to just step back to understand this. In the services space, the disruption will come from technology. Any growth, whether you take any of the manufacturing spaces, the output is directly proportional to the money or capital that you spend. Technology is the only space, especially the product space, where the output can be asymmetric, non-linear, and granular, as long as your cost of customer acquisition is kept low. So the cost of customer acquisition in this case, in the case of Bridgeweave, has been kept low because it's a B2B2C model. So what does Bridgeweave do? Essentially, it's a manufacturer of, and it's a 5-year-old company, which has put together products in the artificial intelligence and machine learning space, which actually is at the extreme end of technology. It is new age technology. These are but terms for the moment for most people. But this company has been using these. And the interesting thing is there are products of this kind available in the world, technologies which are, we loosely call them algo, quant, etc. But essentially, use of AI and ML is being done by people. But interestingly, that space is entirely dominated by people like the D. Shaws and the Renaissance Capital or Citadel Securities or maybe a couple of the big bulge bracket firms who use it exclusively for proprietary investments. That's the important thing. Even as a recent SEBI report outlined to you, if 100 people traded last year, 89% people lost money. And what the report didn't tell you is about 7 or 8% actually broke even. And maybe 1 or 2% people made money in trading on the exchanges. So what Bridgeweave is attempting to do is not keep this the domain of only certain exclusive bulge bracket and hedge funds, but actually use this to democratize investment decision making. The good thing is this is not easily replicable. People who develop this over years and years and years and multiple hundreds of millions of dollars spent use it for proprietary. First time in India, it's going to be available, to my mind, for the retail investor, where we intend going through, I say we, when the transaction gets completed, going through brokers, intermediaries, wealth management platforms, with a view to making this available for the retail individual, whether it's a long-term portfolio, medium-term portfolio, thematic portfolio, short-term, any of these, multiple products are being put together. We're also at the moment on a couple of international platforms. And therefore, this market, because they track about 4,500 stocks worldwide on a day-to-day, minute-to-minute dynamic basis. In fact, one of the medium-term portfolios called Equity Rocket actually generated close to 58% return last year, when the Nifty generated just 4%. So these are the kind of, and the reasoning is very logical. If a machine that's constantly learning, improving, factoring 800, 900 factors simultaneously to make decision-making, by definition, intuitively, it will be a superior decision-making to lay individuals who are going on quote-unquote khabar, what's the news of the day, etc. So the idea is to democratize sensible decision-making as an aid to generating consistently superior returns as opposed to the maximum return. In fact, the big thrust in this is to have low volatility for people who generate, who use this portfolio, and they would find returns being consistently better than a far higher probability of success and certainly a better probability of not losing money.
So you are looking to disrupt the stock picking space with AI and ML. Jakes, afternoon, which are the other sectors which are on the verge of disruption or likely to get disrupted? You know, we had NGS, the CEO of TCS, saying every client conversation begins and ends with what generative AI can do for them. Right? According
Absolutely.
to you, in the next 3 years, which sectors stand the risk of being obsolete or getting completely disrupted based on technology? A 3-year, 5-year horizon, according to you, in the listed universe.
At the end of the day, the ChatGPT as the product, for those who've used it, I mean, and I use it very, very regularly, actually is eliminating secretarial. It's probably the most efficient secretary you can have in life. Over a period of time, you can actually modify this, and you should wait for ChatGPT 4 to come through, because that essentially starts processing and use of a whole bunch of APIs and tools that are given to you on a quote-unquote leased basis, because the entire concept of open AI is exactly that. It's open to everybody who can't make these decisions, who can't make these big investments, and therefore these tools come up where each person can actually fine-tune his or her own business. So I think the big sectors that you talked about, things like media and entertainment, things like any services business, could actually get much finer inputs from an assistant who constantly is learning your business and constantly, I mean, for starters, they write the best English there is. They write the most logical sequencing of English sentences. So it actually is thinking for you in what I would consider a refined, more importantly, the next generation way. So the efficiency of the business and the fact that, I would say, technology at its core, the services business, the body shopping, if you will, could be the biggest affected, because a lot of this is actually available. Lawyers can get better assistance with this. Doctors can get better assistance using AI and ML tools. So these are all service related, which can actually, and at its heart, what is it? It's actually nothing but a bunch of high-powered programmed machines learning to get better and better and better, learning on a daily basis, incrementally improving their knowledge level, and to the extent you can give it, fine-tuned, honed to inputs, they'll give you far better output. That's exactly what it is.
Jakes, hi, good afternoon. Surabhi here. So, those are very interesting observations and thoughts on AI. I'm going to steer things back to the market now because here, whether it's artificial intelligence or human intelligence, no intelligence seems to be working, right? Everybody's struggling to find out what next. I don't think we're any wiser. We've got range-bound dollar, range-bound US bond yields, but now they've kind of tamed down to about this 3.5% sort of pivot level. Everybody's saying another 25 bips from the Fed, then the Fed will pause, but then there is a recessionary fear ahead. But I think one of the most telling things as a takeaway from the IT earnings, we'll forget those companies, is that there's something far deeper. It's not just two big banks or two mid-sized, rather, US banks blowing up that cause this kind of a disruption. There is disruption happening in other parts of the US economy, and it's pretty evident in the way those spending decisions are being taken, right? So coming back to the markets, where do we stand? And what are we looking at, let's say, over the next 6 to 8 months?
Let me point out a couple of paradoxes that are there in the market. This is the first time in 3 to 4 decades, that the US dollar is not the safe haven destination when there's a crisis. In fact, this is the first time that the US dollar is noticeably weakened during a crisis, number one. Number two, this is the first time that people seeing the disruption in bond markets, disruption in other markets, have rushed to hitherto seen as dead or uncertain asset categories. People have gone into Bitcoin, which means that the de-dollarization theme from a market is actually gathering storm, where people are saying any asset where tomorrow there could be use of that asset from a trade or transaction perspective should be bought into. The entire trend of people like India and China using the yuan or the Indian rupee for bilateral trade is taking shape much more. Maybe it's a few countries today, maybe more and more countries will come in. As it is, Russia is supplying oil to India, Iraq wants to do it at prices well below the sticker price, which which your commodities team covers every morning. So we might see an $80, $85, but I can tell you all Indian oil companies buying Russian or Iraqi oil are doing so in the early 50s or late 50s in terms of pricing. So the concept of individual bilateral currencies or currency is already gathering storm. So that is the one big trend. The second big trend, again, most paradoxical, is the equity market volatility did not go up anywhere close to the extent that it used to during 2008, etc. Imagine you're talking about Credit Suisse, you're talking about SVB, banks collapsing. Yet the index, the volatility index actually remained in well and truly sane levels and well below the GFC highs. Number three, the fact that people rushed and the NASDAQ was the best performing index means that people found the balance sheets of the Apples and the Googles and the Microsoft far safer to go to, because from a reserve perspective, they probably have cash reserves higher than what most countries in the world do. So from that perspective, these companies were bigger safe havens, paradoxically, because the NASDAQ yielded 17%, and while other asset categories collapsed and the dollar actually declined. So I think there is every time it's different, they say. And the difference is that at some point in time, the equity markets actually turned out to be a greater safe haven than a crisis would have you believe. And I think from that point of view, because whether it's politically, whether it's economically, or on reasons that we talked about, the Indian macros are very, very strong. I think the FX reserves position is strong. Our bilateral positions improving, and retail is constantly putting more money in. Our dependence on FI is down. FI holdings are at virtually 12, 15-year lows. So from all these perspectives, I think we are very, very strongly positioned in India. We may go through a period where we are overvalued compared to historical averages, and we may continue to be for the next few years. But I see strong retail flows continuing to buttress the markets. And at one point in time, maybe the foreign investors returning. But to me, the combination is, and with so few IPOs around the corner, anyway, large, meaningful IPOs, the fact that the secondary markets are benefited is a truism.
Jakes, thank you very much. Appreciate you joining in. Good luck with that acquisition, and speak with you soon again. Thanks indeed. And Jayakumar at Prime Securities. The market's down 115, which means that even from when we started at 2:30, we are up a little bit. It's a steady incline upwards. Not a very sharp incline, as you can see on the graph, but it is an incline nevertheless. We'll take a quick break here. On the other side, we'll get you what dealing rooms are talking about, D Street Chatter with Nimesh, and our technical calls with our experts coming up as well. Stay with us.